I've been away for a week, so...
Isn't it, Mark? Mark, it's okay now. Everybody keeps telling us it's okay. Even Joseph Ackerman at Deutsche Bank was saying it's okay.
Well, if I look at the performance of some of the property companies also here in England, Hammerson or construction company Barrett, or a property agent like Humbert that is 168 years old, it doesn't seem to be all okay. And yesterday I was actually in a taxi and the lady started to talk to me and she said that her business had fallen off significantly because there were so many layoffs in banks and because the banks had been cutting back on benefits for their employees and so forth. It's quite interesting how it spills into the economy. And I personally think that we are just starting with the credit crunch and that it will get much worse over time.
Well, why don't the equity markets believe that? You know, we had
well,
markets
the equity markets, to some extent, they do believe it. The argument for equities is that we are going to have inflation, and that in an inflationary period, you're much better off by being in equities than in bonds. And with short-term interest rates in America, the Fed fund rate at 2%, there's an argument that you should push money into equities. And also, as of March 17, when the S&P bottomed out at 1256, it was grossly oversold. Now it's rallied 13%, but it's still 51% of the shares that are below the 200 days moving average. So we were very oversold, we rallied, but I think the economy really stinks, and the next sector to really get hit hard in America and elsewhere is retailing. In other words, that the consumer, he has to allocate a larger and larger portion of his income for energy, for gasoline and for food, and he has less money for discretionary items. And if you took out the inflation in America from retail sales, namely food and energy, the real retail sales would be down significantly.